Welcome back. The biggest market-moving event of the final portion of this year has arguably been the signal from the U.S. Federal Reserve Board that only 2 interest rate cuts are likely in the U.S. during 2025. That message sent stock markets tumbling last week and remains a big talking point as 2024 draws to a close. Anna Rathburn is Chief Investment Officer at CBIZ Investment Advisory Services. She joins us now to talk about the markets and about that Fed signaling as well. Anna, thank you very much for joining us. If I understand correctly, you're a critic of the Fed and its messaging on rates in 2025, and you believe that the U.S. economy may need more stimulus than 2 25 basis point rate cuts. Is that correct?
Yes, it is. Good morning, Paul. I've been critical of the Fed for a long time, so I never want to run into one of them. So I think we have to remember that we're normalizing rates. We're not trying to stimulate the economy. And I know there are lots of discussions about whether or not rates right now are restrictive. We do believe that it's restrictive because we have 330 million people here in the United States, and they're all making decisions based on their situations, as well as making business decisions based on local situations. So when you aggregate all of those things up to a single number, which is what the Fed is looking at, you're going to get a distortion. It's going to look like it's actually stronger than maybe it isn't underneath. So we think that it's better for the Fed to continue to go toward normalization of rates rather than staying restrictive. And the other thing is inflation. How do we know that we're actually bouncing around what is a longer term equilibrium post-pandemic? Maybe not going toward 2% isn't a terrible thing. So I think that the Fed needs to maybe look a little bit more forward rather than depending on lagging indicators to maybe prevent making a potential mistake going into the future.
There seems to be a lot of debate and differing views on the state of the U.S. economy these days. What is your view of the state of the U.S.? You've touched on it, but tell us more about your view of the state of the U.S. economy. Some people believe the state of the U.S. economy is very, very healthy, very robust right now.
Yeah, I think we need to be a bit more nuanced on how we view the U.S. economy. You know, if we look at the high earners, for example, let's stay with the consumers for a second, high earners versus lower middle income earners, you see a big discrepancy. And so we can't be looking at the average. There's no such thing as an average person, right? We can't be looking at the average when the high earners are actually really pulling up that number and thinking that everything is okay. I think we need to move away from an aggregated view, which is, arguably more simplistic view, and look at the nuances underneath. And you're going to see a lot of different stories underneath, including a slowing labor market. And that is one of the reasons why I'm critical of the Fed. Paying attention to inflation again, while the labor market is continuing to slow down from our perspective, I think that is basically writing in a thesis that maybe we need to see a recession in order for inflation rate to go back down to 2%.
Okay, with that macro view in the backdrop, what is your view of stock markets in 2025? Where do you see opportunities?
Yeah, so the stock market's a different story from the economy, right? And oftentimes when assets move, they're moving based on relative value because if you're not putting assets into one area, you're going to be putting it into another area. And from that perspective, we are still constructive on U.S. equities. And you might be asking versus what? And that's versus international equities. CBIZ Investment Advisory Services we're allocators, we're capital allocators. So we tend to look at things from a top-down view. So we have been overweight U.S. and we continue to be overweight U.S. into 2025. We are a little bit wary of small caps. As we've seen, it's been a very volatile experience. But at the same time, do you really want to put all your eggs into one basket into 500 stocks, right? So we do think that a diversified perspective and a diversified view is a good one.
Are there sectors of the U.S. Stock market that you prefer?
Yeah, so we have been constructive on growth in terms of styles. And that includes some of those big names that, we have love to hate, is that the term? The Max 7s and NVIDIA, et cetera. We do think that there's a lot of promise there despite its valuations. And that also goes with the theory of maybe there being some weaknesses in the US economy. We haven't seen the volume increase in terms of trading in other sectors of the economy. And we think there's a reason why. It is the slowing economy under the surface. And so sticking with that thesis, we're still, despite the valuations, we're still constructive on tech.
Small cap stocks have received a lot of attention in the second half of this year. There's been all kinds of forecasts, as you know, that the investors would turn away to some degree from the Mag 7 stocks into smaller capitalization stocks. One of the big reasons why in that narrative it was declining interest rates. Now that the Fed has signaled two cuts in 2025, what is your outlook on small cap stocks?
Yeah, that rotation into small caps, I mean, a lot of that was the Trump bump, right? And we got a dose of reality last week, certainly. But, there's a lot of mixed influences here. One of them certainly is rates, because small cap companies tend to borrow on the floating rate market. But at the same time, there is this narrative of Mr. Trump and the administration potentially providing some relief on the deregulation portion of it. We don't know what taxes will look like either next year. So I think there's some, quote unquote, hope that could be built into the small cap space. And so the recent sell-off, which was a reaction to the Fed, may be a little bit overdone.
Anna, thank you very much for this conversation.